The financial world is witnessing a silent but significant movement. Many central banks globally are quietly increasing their gold reserves as part of a financial defense strategy. Simultaneously, Bitcoin, the digital currency once deemed too risky, is beginning to appear in the de-risking considerations of some financial institutions and nations. These signs raise a big question. Are gold and Bitcoin truly, step by step, challenging the long-standing dominant position of the U.S. dollar in the international financial system? This shift not only carries economic implications, but also reflects changes in trust and global power structures. The invisible shield. Why do central banks need reserve assets? After World War II, gold was once a cornerstone in the reserves of central banks worldwide, accounting for approximately 70% of total global reserve assets. However, over time, this proportion sharply decreased, leading to the rise of the U.S. dollar. By 2010, gold comprised less than 10% of reserve portfolios. The U.S. dollar took its place and became the new symbol of global financial power. Nevertheless, this balance of power is showing signs of shifting. Recently, central banks have actively returned to buying gold, and the idea of adding Bitcoin to their reserve asset portfolios has also emerged. If this trend continues, both gold and Bitcoin could experience significant price increases, while the influence of the U.S. dollar could be seriously weakened. Does this wave of gold purchases stem from a short-term reaction to market volatility, or does it truly signal a long-term strategic reallocation? To understand this clearly, we first need to examine the role of reserve assets. Central banks use them as a tool to stabilize their domestic currencies, especially during volatile periods, and as a buffer to cope when situations worsen. A typical example is Japan. When the yen plummeted last year, the Bank of Japan had to sell billions of U.S. dollars to buy back yen, aiming to create demand for the domestic currency and halt its decline. That was not merely a technical maneuver, but also carried significant economic meaning. A domestic currency depreciating too rapidly will trigger inflation, especially when essential goods must be imported. A clear illustration of this is the currency crisis in Sri Lanka in 2022, when the country's foreign exchange reserves ran dry, forcing them to ration fuel, which brought production and daily life to a standstill. The risk doesn't stop at soaring prices. A weak currency also makes foreign currency debts more expensive. A typical example is the tequila crisis in Mexico in 1994. Many companies and banks in the country borrowed in U.S. dollars, while their income was denominated in pesos. When the peso sharply declined, they were unable to repay their debts. That caused the financial crisis to spread. Therefore, holding reserve assets is increasingly seen as necessary, not only for responding to crises, but also for maintaining stability and reducing risks within the monetary system. Furthermore, some countries also use reserves to intentionally adjust exchange rates. For instance, Hong Kong applies a peg mechanism between its currency and the U.S. dollar by buying or selling reserve assets. They keep the exchange rate stable, thereby facilitating trade and protecting the economy from shocks originating in international markets. Understanding these issues helps explain why the U.S. dollar still dominates the list of reserve assets. This currency is not only widely used, but also backed by a deep and stable financial market. When evaluating the substitutability of assets like gold, Bitcoin, or other fiat currencies, such as the yuan or euro, people consider not just their value, but also their reliability, liquidity, and ability to protect against risk. The race for the top position in global reserves is not simply about who has higher value, but also a strategic issue where central banks must weigh economic efficiency, safety, and even political factors. Recent developments indicate that the world may be entering a new phase of transformation in the global financial order. To understand this better, it is necessary to continue exploring the criteria that policymakers always prioritize when selecting reserve assets. Many people think macroeconomic economics is a matter for governments, central banks, or policymakers, but in reality, it directly affects you. From inflation, exchange rates, interest rates to economic cycles. All these impact your wallet and investment decisions. Economic Story Channel will join you in reviewing economic historical stories and current events to see the long-term trends taking shape, and that will help you make smarter decisions in both investing and life. Now, let's get back to the main content of the video. The golden criteria for selecting reserve assets. When central banks worldwide consider choosing reserve assets, they focus on three main factors: safety, liquidity, and profitability. That is the result of a survey by the World Bank with 191 participating central banks. Based on these three criteria, it's clear why gold is gaining increasing attention and why Bitcoin is starting to appear in discussions, even if only as a potential asset. When it comes to profitability, this factor gives a clear advantage to fiat currencies. For instance, a central bank holding U.S. government bonds typically yields an interest rate of about 4.4% in recent years. For the euro, this figure is around 2.4%, while Chinese bonds yield 1.7%. As for gold, because it doesn't generate periodic income and incurs storage costs, its efficiency is calculated as a negative interest rate of about 0.5%. Bitcoin, on the other hand, generates no income at all, as it is inherently just digital data. In the short term, this makes gold and Bitcoin less attractive compared to holding government bonds. Nevertheless, there's still a point that makes gold and Bitcoin attractive. Their value often increases significantly against fiat currencies. This means that if held for a long time, the price of gold or Bitcoin can increase considerably, yielding profits without needing interest. This is why some central bank officials, such as those in Singapore, have expressed interest in including Bitcoin in national reserve portfolios. However, the unpredictable volatility in the prices of these two assets also means they are not highly rated for profit stability, especially in their role of protecting domestic currencies during financial crises. To fulfill the role of currency stabilization, reserve assets need to be easily convertible into cash at urgent times without disrupting the market. Liquidity, therefore, plays a very important role for central banks. In this criterion, Bitcoin faces a major obstacle. The daily trading volume in the Bitcoin market is relatively small compared to the potential volume a central bank might need to sell during a crisis. Even a moderately sized selling action could cause Bitcoin's price to drop sharply. That situation makes many policymakers hesitant to include Bitcoin in national reserve portfolios. Gold and the yuan have better liquidity, and the euro is even more robust. But the US dollar remains at the top. The reason is that this currency is widely traded across global financial markets, especially in the U.S. Therefore, if a central bank needs to sell dollar-denominated assets, they can do so without impacting the true value of the asset. Liquidity is not just about easy selling, but also efficient buying. In this particular aspect, both gold and Bitcoin encounter difficulties. Finite supply makes accumulating large volumes more expensive over time. When a poorer country tries to increase its reserves with gold or Bitcoin, they might inadvertently drive up prices, making further accumulation increasingly difficult. Meanwhile, the U.S. consistently maintains a policy of encouraging trade, especially importing goods from many developing countries. By doing so, these countries can earn dollars through exports rather than necessarily having to buy them directly. In the long run, this helps the dollar maintain its position as the most popular and accessible global reserve asset. The aforementioned flexibility combined with the deep and large U.S. financial market makes the dollar virtually unrivaled. In terms of liquidity, the euro also has a strong network, ranking second, but it is still difficult to compare with the dollar. Large volume gold transactions are more complex, and Bitcoin transactions are almost unstable when considering the scale requirements of central banks. Profitability and liquidity help illustrate some of the attractiveness of a reserve asset. But what constitutes the core value is the safety factor, the level of trustworthiness when the market falls into crisis. The volatility and inherent risks of Bitcoin and gold lead to questions about their true ability to protect national value. This role is still held relatively firmly by the US dollar, despite political or economic challenges. The next question is whether gold and Bitcoin can truly become safe havens or are merely temporary speculative instruments. That will be further clarified in the next chapter. Safety first. The hidden battle for stability and trust. In the international financial world, the concept of safety when referring to reserve assets typically relates to two main factors. First is price stability, meaning the asset has a low level of volatility. When considering this factor, gold and Bitcoin are often not highly rated because both have a fixed supply while demand can fluctuate erratically. This makes their prices prone to sharp increases or decreases. History shows that gold was once very volatile, and Bitcoin even more clearly so. In 2022 alone, Bitcoin lost more than 50% of its value, although it later strongly recovered from 2023, helping central banks recover some of their losses. Nevertheless, these institutions do not operate as investors seeking profit, but as defense forces during crisis. They need stable assets to protect their currency during times of tension. Therefore, an asset like Bitcoin losing half its value in just a few months is difficult for them to accept. Some still argue that if Bitcoin were more widely used, it would be more stable. However, gold, which was once a global monetary standard, has always been volatile even during its peak periods. Bitcoin has the potential to be even more volatile because its supply is more limited than gold, which can be further mined when prices rise. Therefore, in terms of value stability, fiat currencies like the dollar are still considered safer options compared to both gold and Bitcoin. In addition to price concerns, the safety factor is also viewed from a physical perspective. During the Cold War, the fear of an attack from the Soviet Union made many countries feel that storing gold in nearby locations was too risky. Previously, during World War II, many European countries like Belgium and the Netherlands lost most of their gold reserves to the Nazi German forces. Therefore, storing gold in London or New York, places considered safer, became common practice. Once you trusted the U.S. to hold your gold, it's understandable to continue trusting them not to confiscate your dollars. Compared to Bitcoin, from a theoretical perspective, owning Bitcoin can be extremely secure if the holder self-manages asset security. But reality shows many cases of hacking when depositing funds on exchanges or completely losing assets simply due to forgetting passwords or damaging storage devices. This increases the risk, making Bitcoin a much less accessible option compared to the US dollar or gold. The factors mentioned above have contributed to the current leading position of the dollar. The less efficient gold market, which yields little return and is frequently volatile, is why the U.S. currency maintains its core role in many countries' reserves. Not only that, the strong development of the U.S. economy has led to an increase in the dollar's liquidity in the global market. But things don't stop there. Recently, there are signs of a significant shift emerging. More and more central banks are actively buying gold again in increasing quantities when measured by unit. The question is, what is driving this trend? Is something changing in how countries perceive the value and safety of gold? It's not just purely economic factors contributing to this new development. Disruptions in the geopolitical landscape, with complex international relations and potential risks, are forcing many countries to reconsider how they hold assets. Once the world order changes, what was once considered certain, like the absolute dominance of the dollar, may also begin to waver. That's when other options like gold and even Bitcoin are seriously considered as safe havens for the future. And to better understand this shift in central bank reserve strategy, the next section will provide a more specific insight into the true motives behind the current wave of gold purchases, the return of gold buying, and Bitcoin's murky future in reserves. In recent years, as geopolitical tensions escalated and financial sanctions were imposed by the U.S., UK, European Union, and Japan, central banks reacted. A research group from the International Monetary Fund found a clear correlation. When sanctions emerged, quite a few central banks began returning to buying gold for reserves, especially in a context where some major reserve currency issuing countries are also the ones imposing sanctions. Holding assets in the form of dollars or euros gradually became riskier. Therefore, gold, with its long-standing traditional status as a safe asset, is again considered the most reliable haven, especially when stored domestically, as in Russia. Nevertheless, storing gold is not simple. It not only incurs significant storage costs, but gold is also difficult to trade if the owning country is on a sanctions list and cannot access large vaults in London or New York. In that context, Bitcoin emerges as a potential option. With its characteristic as a digital asset, Bitcoin can be transferred across national borders without relying on traditional financial centers. While this might be somewhat complex and expensive for ordinary people, large transactions are simpler and cheaper than transporting physical gold. However, there's still a significant gap between theory and practice. Recent studies by the World Bank indicate that Bitcoin has not truly won over central banks. The primary reason is that this digital currency still fluctuates too wildly in price and has not achieved the necessary liquidity. Therefore, a more practical approach for countries like Russia is to restructure their monetary reserve portfolios. They reduce reliance on the dollar or euro and switch to currencies like China's yuan or India's rupee, which come from more politically friendly nations. The future remains open. It is still uncertain whether central banks will continue to accumulate gold, and if so, whether they will also begin to stockpile Bitcoin. If that happens, the question arises whether the prices of gold and Bitcoin could rise even more sharply, and whether the global monetary order would change. The U.S. dollar, which has been at the center of the global financial system for decades, is facing challenges from both gold and digital currencies. While gold reasserts its safe haven status, Bitcoin represents a significant shift in the digital age. The position of the future reserve currency is still being shaped in a constantly moving world. The reserve currency of the future. In the context where global reserve currencies change very slowly, mainly due to network effects, meaning the more users there are, the more useful and stable the currency becomes, a major shift away from the U.S. dollar is unlikely in the near future. Although there were reports that economic advisors under President Donald Trump suggested that countries wishing to continue using the U.S. dollar as a reserve currency would face accompanying conditions, such as contributing to defense spending. Overall, however, the dollar remains the top choice due to its core factors: high liquidity and reliable safety for central banks. History has witnessed the shift from the British pound to the U.S. dollar, but this process took over 6 decades, even though the U.S. had long surpassed the U.K. to become the world's largest economy. That indicates that even if the U.S. dollar's role declines, this transition will not happen quickly. Furthermore, fiat currencies like the dollar or euro are considered much more stable due to their ability to control supply. Until the world truly falls into a comprehensive crisis, the likelihood of central banks fully shifting to holding gold or Bitcoin remains very low. Nevertheless, in an era where the global order is increasingly fragmented, many central banks have begun increasing their gold reserves to hedge against potential political and economic risks from the U.S., European Union, or China. In that context, Bitcoin, if more widely used and more liquid, could also play a certain role. It has the potential to become a digital asset similar to gold because it is easy to transfer across borders and trade in large volumes. If central banks increase their investment in Bitcoin and gold, the prices of these two assets could continue to be pushed higher. However, most of the expected impact may already be reflected in current market prices, and no one can be certain what might happen next. In summary, although gold or Bitcoin are unlikely to replace the U.S. dollar in the short term, their strong resurgence, especially Bitcoin, indicates that the financial world is entering a period of significant volatility. Bitcoin has attracted capital from many large institutions, driving up prices and sparking lively debates about the future of central bank digital currencies. The race for a foothold in the global reserve system is still long, and central banks' upcoming decisions will continue to reshape the global geopolitical economic landscape. Thank you for accompanying Economic Story Channel. If you found this content useful, please support the channel by liking and subscribing to Economic Story Channel. Now, goodbye and see you again.